All right, hopefully I'm recording. If I'm not recording, I apologize. All right, so we know the contribution margin and how it's computed. We know in general how the break even is computed, and we know why we break even. We have a good idea. Target profit in units. Now, again, as I go back to this one, the break even is pretty much, you take your fixed costs plus your profit, which is in this case 0, and you divide it by your contribution margin per unit or your contribution margin in dollars. So we know that. But then the next calculation, which is not too different, it's going to be our fixed costs added to our profit divided by our contribution margin. And why do we do this? We're doing two sides. One, how many units we need in order to break even. And if we try to target a certain amount of revenue, we can use pretty much the same calculation, just add the profit to it, and that will give us the number of units that we need to produce in order to have a targeted amount of profit. Now, the margin of safety is what we talked about. Margin of safety is the number of units sold less the number of units needed to break even. So that's essentially your target. You want to have a little bit of a cushion between not making any money at all or not losing any money, of course, and that little piece of profit that you want to earn. And why would we think having a target profit, calculating a target profit is important? Because anybody think about, we know why it's important to break even, but why would we want to calculate our target profit in units? How many units do we need to produce and sell to reach this profit margin? Why would it be important to have that information, even if it's an estimate? Anybody want to take a guess as to why you feel that having a target profit in units is important?
So then you don't overproduce or underproduce?
That's important. And we're going to talk about that a little bit in the coming weeks. I don't want to jump into that because that's a whole chapter. But that's very true. You don't want to overproduce. You want to make certain that what you're producing, see, the thing is, if you have a big target, and you have all of these different points where you want to hit it, you're more likely to do so if you're clear as to what you're trying to target. In this case, we want to know how many units that we need to produce so that we produce what we can sell. We don't want to underproduce, meaning we miss out on revenues. That's horrible. But we don't want to produce too much. Why? Because inventory is expensive. We're in the mode right now in this particular chapter, and I think the chapter prior to this, we're in the manufacturing mode, not in the merchandising mode. So in a manufacturer's perspective, I'll use Apple, for example. Apple is under continual competition, continually competing with Samsung and others for that market share. And it becomes important for Apple, even though Apple is pretty popular and many people have their products, whether it be their MacBooks, their tablets, or their phones. Many people have their units. The bottom line is they still have to always be considerate of, we are not the only provider of this. It's highly competitive. The profit potential is not very high, meaning they don't have a 50% profit margin. It might be 35. And this is Apple, and Apple is an extremely successful firm, and their profit margin is not real high. It's 35%. So for us, targeting the amount of units that we need to break to get our profit that we are looking for is important, so we do not overproduce that product. We do not underproduce, so that we know that this is what we need to do. Now, if we produce enough products and we reach our target, the next quarter, in my opinion, we go back and reevaluate our target. But we most certainly need to have something by which to shoot we aim our direction of how many we're going to produce and what the profit would be if we produce this much when compared with the break even. So yes, that's very important. And I think we're going to talk about that a lot in the next chapter. So the contribution margin ratio or percentage, I went over this a little bit last time, but I want to go over it again. Remember, the contribution margin in dollars is going to be the sales price. That's assume the sales, in this case, $50 minus the variable cost per unit, which is about $13. The difference is going to be your contribution margin. Now, what we want to do is convert that to a ratio or a percentage. So take our contribution margin per unit and divide it by our sales unit, price per unit. That will give us our contribution margin ratio or percent. Or we can just take total sales minus total variable cost divided by total sales, gives us our contribution margin. Either way, it gives you the same thing. The most important thing is knowing that the contribution margin is the relationship between your sales and your variable costs, whether it be your variable cost by unit and your sales by unit. I'm going to sell my product for $50 each. In this case, we're talking about some kind of peripheral with Apple, because I don't think anything with Apple is less than $500. But let's just say, for the sake of argument, Apple is selling a particular item, and they're going to sell it for $50 each, and it costs them in variable costs, not fixed costs, but in their variable costs, it costs them $20 to produce. So we take our $50, subtracting our $20 cost, variable cost, we get our contribution margin. That contribution margin is going to be very important because we're going to use it to convert it to a ratio and to use it to calculate our break even in units and in dollars. So really knowing what that is, and it just is a little bit different from the financial statements in that you'll have our revenues minus our cost of goods sold, give us our gross profit. So if you look at it side by side, you can see some subtleties and differences as to relates to why in managerial accounting we're concerned with variable costs when compared with our sales to get our contribution margin. Now, let me know again by turning on your mics if you can't see as I'm changing the screen. So if we want to break even and we want to lay side by side what our targeted profit is in sales, what the organization is doing in cases like this is to see how can we analyze the changes in profit based on the number of sales that we produce. Because remember, as we produce more product, our variable cost is going to go up, because our variable cost defined is the changes in cost in direct proportion with the changes in volume, in volume produced. So logically, the more we produce, the higher our variable cost is in direct proportion to that. So having our targeted profit and at hand gives us an idea of where we're going and whether or not changes need to be made in terms of the production or the production of our units. We want to produce more than enough, but not too much. We don't want to have idle inventory sitting on our books. And because manufacturing organizations generate 90% or more of their revenues from a specific product being sold, it becomes quite important to be able to have a good idea where you're going in terms of your target. Now, this graph is just giving you an idea of where it breaks even.
Can we go back to that last slide for a couple seconds real quick? So I can finish right.
Yep. Now, remember, the break-even calculation and the target profit calculation are really the same, because it's going to be your fixed cost plus your profit divided by your contribution margin. And when we did it last time, if my memory serves correctly, we did our break-even was calculated by fixed cost plus 0, because we had no target. Remember, it was like 44,000 or whatever dollar amount plus 0 divided by our contribution margin. Well, with the target profit, we're going to take our break even plus that target number, whatever it is, and divide it by our contribution margin. Can I go to the next screen? Let me know.
Yep, thank you.
Not a problem. Now, this is just a graphic picture of what it looks like. I'm going to try to see here. I'm going to look at, I think, the targeted break-even point looks like a little over $100,000. And let me see if I can get the bottom half of my screen to show. It doesn't show that bottom half. But what this is saying is, at any point in time, you can see the relationship between the variable cost, which is going to be here, the total cost here, and which has here, and how it relates to the revenue, total revenue, which is here. The revenue number is on top. Our cost, total cost is on the red line, and the profit is going to be that difference. And I like graphs because they're easy to figure out. You don't have to use a lot of numbers. You basically are trying to show relationships. And here we're showing the relationship among three variables: the profit, the total cost, and total revenue. And at what point do these intersect? The intersection, if you will, is called our break even. And for many of us, we don't really think about break even too much because we're not really trying to produce anything. But if you're thinking about an organization you're doing business with, like Apple, and you noticing their prices go up. Why would their price go up? Well, because they are dealing with excess demand. And the more a product is demanded, the higher the price, right? But when you're dealing with a product that's not in demand and they have excess inventory, you will notice that the prices go down. And that just gives you an idea of why prices fluctuate so much. When you're talking about products and services, like you're talking about why is it this product is how can they afford to put this product on sale? Think about it in light of this: the break even and then target profit. If they have excess inventory, as was noted by your classmates, like you want to target your revenue, right? You don't want to produce too much. But what if you did produce too much? What would happen if you produce too much and you have excess idle inventory? Well, organizations will have to go through this process here in a way and say, look, we are having a problem here. We need to get these items off our books. What if we target our sales to be this much so that we can get these idle inventory off our books? What would be the output? What would be the consequence of us providing a sale? Meaning we reduce this number here. We reduce our revenue. And here's the space between our revenue and our total cost. If we were to reduce that, how much can we reduce it and still not lose money? That's the most important question. When you have excess inventory, you made a mistake, you estimated too high and you produced too much and you have to get rid of the inventory, but you don't want to lose money getting rid of the inventory, how much flexibility do you have? And when you look at the graph like this, you have a little bit of space here. You have a little bit of room where you can offer a sales discount or put your product on sale and still maintain profitability. Because at this point, you're still making a profit at the highest level here. And it gets a little bit lower to the point where it actually intersects with your costs. So there's a good amount of room here. This is just graphically showing you what the impact, if they were to make a change in their sales price, leaving all the costs constant, everything remains the same. The only thing that they're going to change is the sales price. And they'll see as each time they sell, the sales price gets lower, their profit gets lower, but they know at what point to stop. So it provides them not only a target of what their revenue should be to avoid overproduction of inventory, but also if they do have excess inventory, how much can they reduce their revenue and still have that margin of safety? So that margin of safety in this example, in my personal opinion, without any numbers, my margin of safety is going to be from here to here. That's going to be at margin of safety. And why? Because it's a little bit over the break even. It's that cushion. Some textbooks call it cushion, but it's really that little bit of a flexibility between the profit and the cost before you actually go into the red, which is right here. This is where you're in the red. This is the loss area. This is the break-even area here. And here's the margin of safety between here and here. And then all up here is your revenue. Now, I like graphs because they're easy to explain and they're easy to see what's exactly happening. Now, I don't know in your homework that you have this calculation, but it's kind of important to see some of the calculations that you'll be dealing with, not necessarily totally in this chapter, but also in the chapters that follow. The weighted average contribution margin per unit. These are just different ways of analyzing your contribution margin. It is nothing overly complicated about it. It's just more than one way to look at it. And what I'm trying to communicate here is when you're trying to make a decision, you've got a lot of data and you've got a lot of information. How am I going to use it to make a decision? The question then becomes, what am I trying to accomplish? Am I at the beginning of the manufacturing process, beginning of the year? And I have last year's data and I'm trying to guess as to what I should do for this year. So if I made a profit of 20% last year, overall, my contribution margin was 0.20. And my boss, which is the owner of the company, said, well, I want to see if we can make we can change our contribution margin to make it a little bit larger. Instead of it being 0.20%, I want it to be 30%. I want to have 30% of my excess to cover my fixed costs and give me a profit. And his job is to think, okay, boss, I know you want us to increase it to 35%. We got to think about how can we do it. And what we're doing in this exercise is just showing you different ways of answering questions or providing management with input. If they want to make more, if they make more than one product, how do they determine the break-even point for both of those products? Or in this case, how do we adjust our contribution margin and still produce enough? If we increase our contribution margin, you have to deduce that the break-even is going to get higher. So that's an important, and that's the important part about this. Know what the relationships are. If our contribution margin is going to be 0.35, you have to assume, considering a break-even and not a margin of safety, that our break-even in units and in dollars is going to be much higher. And can we afford that? And that's what, so your boss comes in and say, I want to increase our revenue. I want to increase our contribution margin. How can we do it? You have more than way to do that, starting with your break-even as your guide. And in this particular chapter, I think most of the calculations are very straightforward. You might see maybe 4 different calculations, 2 of which we talked about already. Well, actually, we talked about 3. We did our contribution margin, we did our break-even, and we did our margin of safety, and we did a high-low method to do that. But that's more information. Now, the next step, I think we talked about this a little bit. I'm going to stop right here. I don't want to go too fast. Contribution margin, ratio, percent. Again, what is the contribution margin? What are we trying to analyze? What information does this calculation give us? That's really, I would say, the most important thing. It's not so much, I don't want you to calculate anything incorrectly. God knows I don't want that. But if you don't understand what this information is giving you, it could be, it doesn't matter if it's right. You can't use it. So when you're reading through the chapter, ask yourself, what does this information give the user? How can this user use this information? If you could answer those questions, I think you got it. I think you understand what that particular formula would give you. Same is true for using sensitivity analysis, using any kind of VP, CVP. It's important to know, what does this information give the user? How can I use this information to make a decision? And sometimes the question may guide you to using a high-low method, or it may guide you to use a break-even and incorporating profit, or it may guide you to using a regression analysis. The most important thing is, I want information that I can create an estimate, but I want it to make sense, and that I can use it to make a very specific type of decision. I want to produce this product. This is a brand new product. This has already gone through R&D. We've already gotten an idea of the individuals who might like it, who they've tested it. Now we're ready to go and produce it. All right, great step. But before we start producing, we need to tell our manufacturing plant managers, I want you to produce X amount of product. And that number will be our break-even point. So, and again, it's all about asking those kind of questions. If they want to know how many we need to produce, your job is to tell them how many to produce. But you're not just telling them, this is why we are producing this amount of product, because our break-even is just below that. And this is a new product, so we don't want to have some huge margin of safety. This is a new product that's relatively untested in the marketplace. So we're taking a risk putting it out on the market. We feel confident with our data to do this. But the most important thing with this launch is we need, at the minimum, is to break even. So giving your plant managers that information right from the beginning and monitoring the sales, you can say, okay, the first year of producing this product, we did in fact break even. And now next year, we'll do some other changes and and see if we can now target our profit. Now we know what our break even is, and we are solid with our break even. We don't need to change it because it's proven to be accurate. The next step is to incorporate a target. And then the manager say, well, I want to see a 20% profit. They run the numbers, they do the analysis, and they only made 15%. That means that 5% they didn't get all of their profit. So they kind of dipped into it, almost getting close to their break even. It doesn't matter. It's not that the numbers are going to be 100% accurate, but we certainly want to have reasonable numbers that you can reasonably predict and explain. And we'll talk about dealing with variances later. The most important thing is using the fixed cost and the contribution margin and the ratio and how to calculate those are important, but knowing when they are relevant and what information they tell you is even more important. Sensitivity analysis, changes in one or more variables. We want to talk about fixed costs. We want to change the factors. Again, when things get more complicated and everything is not just linear, we might have more than one product. We might have two products. We might have a division that we're trying to analyze. Sensitivity analysis probably would be much more statistical in nature and provide a lot more complex ratios and complex calculations. But in the end, as your organization grows and as the level of products that you provide into the marketplace become more voluminous, sensitivity analysis give you a much more accurate assessment of where you are and changes in sales and variable costs. So sensitivity analysis. And so leveraging, using a fixed cost, using a high-low method, it's basically, in a financial accounting perspective, being appropriately leveraged is a combination of equity and debt, having the proper balance of equity and debt. All right, that's called leveraging. Now, when we're in a managerial perspective, how do we leverage? We're going to be leveraging the risk and reward. And the risk and reward is going to be more or less how to analyzing the break even to reduce or eliminate losses, using volumes to anticipate the cost. So it's going to be leveraging. In this case, I would say it's going to be fixed costs and variable costs, and having those properly balanced sufficiently well so that you can increase your ability to, make more money or cover your administrative costs or increase profitability. So in this case, the leverage is not it's going to be more the costs, the variable costs and the fixed costs, and having them in appropriate measure so that you can, in many ways, move beyond break even and even go higher in terms of your profitability, covering costs. So leverage, I guess, would be fixed costs and variable costs kind of being balanced together, versus in financial be your equity and your debt, and having the appropriate levels of equity and debt to be more balanced and be more flexible. So the main thing here in this slide is really just to tell you about some limitations. Don't use it for everything. It has its place. It can't tell you everything. It's not intended to tell you everything. It's really there to answer very specific questions. And when you're trying to make a decision about something, you got to look at more than financial reasons, which is why we talked about in the first chapter, we talked about managerial accounting differs from managerial accounting differs from financial, because financial is only dealing with financial information. Managerial, you'll have both. You'll have non-financial information that you'll be using to make a decision, and financial information, using those together to make decisions. So again, the constraints would be the limitations, the weaknesses, the disadvantages, and knowing how to use it so they'll give you what you need and use it in the appropriate way. Because we want to make sound, practical business decisions. And that's the whole point of that. So variable costing, as you know, cost that varies alongside the production process. But variable costing is different from financial accounting, because financial accounting uses absorption costing, What's the difference? And I keep going through the difference between financial and a difference between managerial, because sometimes there's a line drawn in the sand here, and you need to know what side are you on. Are you on the financial side, or are you on the managerial side? Managerial accounting is only concerned, when we're talking about contribution margin in particular, about the variable costing. We want certain costs that can be attributable to the process of producing a particular product. In absorption costing, for example, and this is all in financial, you're going to be dealing with all costs, all expenses, every single one. And so so your contribution margin is going to be very different from your gross profit when you're looking at financial accounting versus managerial accounting. And that's what I want to make clear. Just know the difference. Know why variable costing is different from absorption costing, which is financial accounting, because financial accounting is considering all costs and expenses. Variable cost is only considering the variable costing and fixed costs. And that's what it's considering when it is calculating your profit or your contribution margin. So fixed costs move from period costs and can't be controlled. We are going to be dealing with internal decision making, not GAAP. Again, when you're making more than one product, you're going to have to consider inventory. Thus, GAAP is going to have higher profit than the variable costing. Again, note the differences, why they're different, and how it's relevant to what we're talking about here. And when you sell products, obviously, cost of goods sold is going to be much, much different from the variable costing when you talk about GAAP. So, because the variable costing, we're just going to talk about costs that change based on production. Cost of goods sold is considering all costs associated with that product being manufactured and sold. So that's why they're different. And in this chapter, I think we're going to introduce why they're different. Absorption costing is GAAP. Variable costing is managerial. We're concerned with variable costing. Variable costing is going to show a lower profit because costing might, again, just know the difference. We are not tied to our GAAP reporting. We are using this for internal users only. And so we can deviate as much as we want to, which is why variable costing does show a different contribution margin. So with that, I want to talk a little bit about Chapter 3 as it's shown in your textbook. And I want to bring to your attention a couple of things that you'll need to think about. How do we calculate our contribution margin, and how do we use information for decision making? So I'm going to stop sharing at this point. I'm going to see if I can do this a little bit better. All right. Now, let's think about, let's see. Work on a couple problems here. Now, I'm going to try to work on some problems. So give me a second. I'm going to share my screen, and we're going to work on problems together. If you don't know the answer, that's okay. In this chapter, I'm assuming that no one has had the opportunity to read Chapter 3. So I might be on my own in terms of doing it, but that's okay. I just want to make certain that we can just get an idea of what this chapter is talking about. When you start reading the chapter, you can start working on your problems. You'll have a good guide. So give me 1 second. I'm going to open up my file. Hold on a second. Save this. I'm going to use a Connect kind of software because it makes it a little bit easier. All right. And then we print this. All right. Now, I'm still working here. Right. Hopefully this will work. Just give me a second. All right. All right. I might need my glasses so I can read. Okay, let's see. Share my screen. Hopefully this works. And I'm going to need your feedback to make certain that we got this. Tell me if you can see my screen. What we're looking at is an example. It says on the top, cost, volume, profit analysis example. You can see it. Good. At any time, I need you guys to pop in. So I won't get upset. You got to pop in and tell me that you can't see something because I might be skipping, I might be going to a different slide. Okay. We're going to try to do some demos here. Let's see if we can pull this off today. It gets a little cumbersome when I'm not working on a board, so please be patient with me. All right. Okay, here we go. I've got a few problems that we're going to work on, and I'm going to be using my paper and pen and my calculator as we go through them. So, and I'm going to provide you with a copy of these questions and the answers at the end. Well, not at the end, but once I save the video and upload it to the announcement page. So don't worry. My suggestion would be to watch carefully, ask questions, and see how I struggle through these problems. All right? Okay. Now, we are going to do 5 problems. And once we are done with these problems, I'm going to turn you guys loose. I'm not going to hold you too long because this chapter does have a lot of information and it might be overwhelming. So I know when to put the brakes on. And we will finish it on Wednesday. So for now, let's just walk through this. I'm going to be reading from my paper because I have on reading glasses and it's hard to see like this. So bear with me. Question number 1 says, Pacific Parts produces a single part for sale. The parts cost, and I'm writing this down. When you're going through your problems, particularly on your homework or you're doing any assignment that requires calculations, I do believe printing it off helps for many of you, and using something like this. Why am I doing this? Because for me, I need to write, I need to see, I need to feel as I'm doing something so I can understand it. And maybe you're not necessarily an auditory learner, meaning you learn by hearing, like my husband. You might be learned by doing, or you might be learned by seeing. I learn by seeing and doing. So do the method, use the method that works best for your learning style. All right. That being said, they produce one product for sale. The part sells for $30 a unit, and I'm writing this down. The sales price per unit is $30. Okay, so that's my SP. Then it says the fixed cost, my FC is $890,000 unit annually. All right. Then it says the production and sales is $270,000. This is units. And then the profit is $1 million. All right. And let me see, what else do I have here? Good. Now, the question is asking, what is their variable cost? Now, there's a couple ways to do this. I'm going to do it one way. And then you tell me if that makes sense to you, then I'll try it another way if we can get the right answer. I'm going to prepare a contribution margin statement. So what I'm going to do is I'm going to take my sales is $30 per unit. Then I'm going to multiply it times the 270 units. If you can see here, it has here 270 units, 270,000 units sold annually. So if I take the 270,000 and multiply it by the $30, I'm going to get 8,100,000. Okay, so that's my sales. So my sales, my sales revenue is 8,100,000. Now I need to have my variable costs. Now the variable costs, it says the production and sales of 270,000 units results in a profit before taxes of 1 million. What is my variable cost? And then I subtract that until I get my contribution margin, and my profit is 1 million. Now I can back into it, right? So think about it. I have here my 8 million in revenues. I don't know what my variable cost is. I don't know what my contribution margin is, but I do know what my fixed costs are. My fixed cost, according to this, is 890,000. So I'm going to change the viewpoint here. I'm going to stop sharing, and I'm going to do all of this on an Excel spreadsheet so you can see how I'm using Excel to help me solve my problem. All right. Just give me a second. Now, I'm going to not put things on paper because I really need to see. All right. So now the problem gave us, it says here, the sales price per unit is $30. The fixed cost
I can
is,
see the Excel sheet.
there you go, thank you. All right, here we go. Can you see me now?
Yes, now I can.
Good.
Thank
Now, very good. Thank you. So here we are. We have sales price of $30 per unit. Then we have our fixed costs. I'm going to change this. Fixed cost is 890,000. I'm putting that here. Very good. And SP is $30 per unit. So I'm going to prepare a contribution margin. And I want my profit, according to this, is $1 million before taxes. Profit is $1 million. Good. Now I'm going to prepare a contribution margin statement. Sales, variable cost, which I don't know, contribution margin, fixed costs, and profit. Now I'm not going to use the Excel for calculating because I have to back into it. I don't know what my variable cost is, and I'm trying to compute that. So if I say my sales is going to be $30 times the 270,000 units, and I'm going to put on here, units sold, 270. So far, so good. I got one number I feel good about. My next step then, oh, no. All right. So now I have to find out, I'm trying to solve for the variable cost. And I don't know what it is, but I can back into it. Maybe. This number has to be 1 million, right? Let's make sure we're right. All right, good. So if we assume that our sales is 8.1 million, our fixed cost is 890,000 because they gave it to us. And I'm gonna put my glasses on here. And our profit should be 1 million. I'm going to back into it, don't you think? Let's see if I can back into it to find out what this number is. So if I say 8,100,000, and I'm going to, let's see. We can also do, oh, you know what? We can do it two ways. We can do it easy. We can say, if we don't know what our variable cost is, we can figure that out by just taking the $30 or $30 per unit. I'm going to do it an easier way. $30 per unit minus our variable cost, which we don't know what it is, and multiply it times 270,000 minus 890. That's essentially, I know it's telling me it's not a problem. Okay. So what I'm doing here is I'm saying if I know what my sales price is per unit, so I'm $30 minus my variable cost, which I don't know. And I know what my units are, which is 270,000. And we know also what our fixed costs are. How can we solve for this variable cost? How can we solve for V? V times a number gives us what we need. So how do we do that? If we're using our little mini contribution margin to help us, we might be able to back into it. So I'm going to get my printer here, and I'm going to try to back into it. Because what we want is our variable cost per unit, but it's not giving us our variable cost. So how do we find it? Well, if we take $23 minus, or $30 minus our, let's see, I'm going to do it. I'm going to back into it. I know what my $1 million should be. I'm going to add 890. And so what I did, now I know what my sales are, and I don't know what my contribution margin is, but I can guess and see what it is. So if by taking the 890 and adding the 1 million, right, I get a contribution margin of, how can I say, 1,890,000. Now I can kind of, I think I know how to do this. So if I want to know what my variable cost is, it's just the difference. So I'm going to take the 1,890 and subtract from that the 8,100,000. That gives me 6,210,000. Now I'm going to make these look like dollars because it's easy to follow. There we go. And I'm going to also make this a little bit bigger. So using our formula, our sales of 8.1 million, which is the multiplication of 270,000 times the $30, right? So the 8,000,001 is 270,000 times $30. The variable cost we didn't know, but we did know what the profit was, and we knew also what the fixed cost was. So I added those two together to come up with my contribution margin. Now that I have my contribution margin, now I can say, oh, wow, now I can back into my variable cost in dollars. Now, with this information, can anybody tell me, can you now calculate the variable cost per unit? Now you have everything you need. Anybody want to take a stab at how to calculate the variable cost per unit? This is the variable cost in dollars. We want to convert it to per unit. How do we do it?
You would divide the variable cost by the, what was it, 890,000 units?
Actually, you're on target. The 890,000 is fixed cost in dollars. You want to do it by unit, and you want to do it by the 270. Now
Okay.
you got the thinking right. That's right. You got it. I love that. Love that. So based on what we're saying, we know what our variable cost is in dollars. We're going to convert it to units. So I took this to a 6.2 million, and I divided by the units sold. So my number is $23. So I'm going to unshare my screen again. I'm going to stop sharing, and I'm going to go right back to my assignment, my homework assignment. I'm going to share that. Let me know if you can see it.
Yep.
Okay.
Yep.
Now I'm going to put $23 here. I'm going to check it to make sure I'm right. I hope I'm right. Okay, good. All right. So let's talk about what I did. And I'm going to unshare this time because I want you to see it in light of the Excel spreadsheet. So I'm going to share my Excel spreadsheet again. What I did in this case was I didn't have this number here. I had to solve for it. I had to figure out what was this number. And it gave me enough information to do that. Remember, this is just a plain old calculation. We multiply the number of units that we sold times the price of each one of the units. So that one was a pretty straightforward computation. However, the variable cost number and the variable cost by unit was not necessarily easy because we weren't given a lot of information, but we could back into it. And by using this I would call this income statement, this contribution margin income statement, I was able to back into the contribution margin, which allowed me, because now I know the relationship between the contribution margin and sales, that difference is going to be my variable cost. I was able to calculate the variable cost in dollars. And once you have it in dollars, all you need to know is how many units we produced, in this case 270 units, to come up with our variable cost per unit. So if we did it based on units, sales price by units would say 30 minus 23 gives us $7 per unit. So the variable cost per unit, or I'm sorry, the contribution margin per unit, excuse me, contribution margin per unit is this. So this question is not asking us this, but do we have enough information, ladies and gentlemen, do we have enough information to calculate the break even? We might not. What do you think? Do we have enough information to calculate the break even? And if we do have enough information, can you tell me how to calculate the break even? I know the question is not asking us to do that, but I just wanted to take us a little bit further. Can anybody calculate the break even? Do we have enough to calculate the break even?
I don't know how we do it, but I would say we have enough to calculate the break even.
All right, so we have our contribution margin. We have our fixed costs. Now, let's see. Let's do our contribution margin per unit. Let's see. Hold on. $7. So let's take the 890 divided by the 7. And then let's do the same thing. I'm just using Excel. This, divided by this. I did that right. And then we take the 890 divided by 1, 2, 3. So to break even, you have to produce at least 127,100 units. To break even in dollars, we have to earn 3.869. So here's our break even. I'm going to put here break even dollars, and here break even units. So yes, we do have enough. All right, but I'm going to change that. I'm going to go back to my classwork assignment, and we're going to try another problem. So that one we look like we got it right. Now, can you still see my screen? I have on the problem number 1, right?
Yes.
Good. Number 2, let's try that one. This one here, it says, I'm reading from here because I have my reading wrong. Casey's Cases sells cell phone cases in a small kiosk. Casey charges $30 per case. The variable cost per case, including the case, the royalty paid to the mall, and so forth, is $26. The monthly fixed cost for Casey's cases, good Lord, come on, Casey's Cases, you know, is $2,480. So the question's asking us, how many units must Casey sell every month to break even? Casey believes that he can sell 700 cases in a month. What is the margin of safety in terms of number of cases? Now, I'm going to take this data and I'm going to put it into my Excel because I like for you guys to see how I'm computing it. Okay, so I'm going to stop my share. We'll go back to this screen. I'm going to go back to my Excel spreadsheet again, and I'm going to try to work this problem out. I'm going to go down here and put in the relevant data. The first thing we already have is the fixed cost is 2,480. The variable cost is 26. And what else do we have here? Oh, the sales price, right, per unit is $30. Let's see, what else do we need? I think we have enough. So the first question then is, we're going to calculate the number of units that we need to have to break even. So to do that, we need to have our contribution margin, and that's going to be what? What's our contribution margin? It's going to be the difference between the VC and the SP. So I was going to take the sales price minus the VC equals the CM. So far, so good? Now let's put the numbers in these little spaces. Let's fill in the gap. The first is the sales price, and I think it's $30. And our contribution margin or our variable cost is $26. Oh, sheesh, I gotta make it a formula. Okay, so it's $4. So we've got all we need. So I'm gonna say that I'm gonna take this number, divide by this number to get my answer. All right, and I'm gonna label this so it can make sense. This is gonna be my break even. And what I did was I took my variable cost, subtracted from my sales price to get my contribution margin, which in this case is the 4. And I divided the 2,480 into the 4 units. To get my break even. So my fixed cost divided by my contribution margin. So the answer to number 1, I'm gonna put in green because we're not gonna go to that page just yet. We'll get there in a second. And the second question is asking us, Casey believes that he can sell 700 cases a month. What is the profit margin? What is the margin of safety in terms of the number of cases? So if the number of cases to break even is 620 and they're going to sell 700, I think that's important information. So I'm going to say if I'm going to assume 700 units is going to be our estimate of what we can pull together. I'm going to subtract that from our break even. That gives me 80 units. This is going to be my margin of safety in units. So I'm going to highlight both of these. Now let's stop this and then go to the actual assignment and see if my answer is right. So I came up with a 620, let me put it in the right space. In my margin of safety, I came up with 80. Good. Now let's talk about what we did here. The goal for Casey is a self-employed gentleman or lady, and he or she wants to be able to see what would happen if our profit were to increase. If we were to say, I want to have the number of cases I need to sell that gives me a little bit of a profit, or I'm targeting a profit. I want to target a certain level of profit, but I want to see how many units that is. So you need to have your break even in order to calculate your margin of safety. That's really important. And secondly, in this case, if I produce 620 cases, my margin of safety, assuming I can sell 700 cases, is 80. So if I sell 700 cases, I have an 80 case cushion, if you will, before I break even and even before I am in a loss position. And so that's a kind of good information. So that person, whoever he or she is, can use that as a guide. Every single month, I know if I make 620 units, I'm actually breaking even. And if I have 700 units, I'm making a profit. And you can even convert that to a percent. You know what I mean? You can say what percentage of 620 is in 700. You can get maybe 10, 12%. But the bottom line is, in terms of numbers of units, I know my little cushion is 80 units before I'm essentially breaking even. Let's try one more problem. This one here might be a little clunky for me to do. Let me see if I can do it though. I'm going to try. This one's clunky because I'm going to have to switch back and forth between screens, but let's see if we can do it. Adriana Corporation manufactures football equipment. Well, first of all, before I go any further, any questions about the two problems that we went over? They don't get more complicated than this. Let me tell you, this is just really, really straightforward. You follow the formulas, you should get the right answer. The more important thing is when you're writing your paper, I think we have a paper in this class, when you're writing your paper, understanding what this information means and interpret it in words. That's going to be really important too. Okay. Number 3, Adriana manufactures football equipment. And planning for the next year, the manager wants to understand the relationship between activity and overhead costs. Discussions with the plant supervisor suggest that overhead seems to vary with labor hours, machine hours, or both. The following data is calculated from last year's operations. Use the high-low method to estimate the fixed and variable cost portions of overhead based on machine hours. And then managers expect the plant to operate at a monthly average of 7,500 hours each year, next year. Estimate the monthly overhead costs assuming no inflation. So the high-low method. Now I'm going to, let's see, can we copy this? I'm gonna see if I can copy it. I don't know, it might not like it. The reason why I'm gonna copy is because I wanna use Excel to do this. It won't let me. Oh, let me see, hold on. Give me a minute. Oh, it won't let me copy it. Wait a second. Okay, I'm gonna try to copy this. Nope. It might let me copy. All right. Just if I go blank for a second, don't worry. I'm just trying to move this over to Excel so I can. All right, just a second. I think it lets me. Very good. All right, so I think it did. So I'm going to switch off from here. Stop my share. And I'm going to share my Excel spreadsheet. And the reason why I'm doing the spreadsheet is because it's so easier for me to try to explain and work through a problem versus using that worksheet. All right, if you can see my Excel spreadsheet, or rather, if you cannot see my Excel spreadsheet, let me know before I get started working this problem. All right. Now, we're going to use the high-low method. And I'm going to try to take a little bit slower with this because a lot more data. And we could probably use do another things that I'm here, but let's just use the high-low method. The variable cost is equal to the net change in the highest activity and the highest, in this case, we're talking machine hours versus overhead hours. So I'm going to use my overhead hours as my numerator. So the highest overhead cost, let me look. If you look at these numbers here, the overhead costs here, from what I can tell, the highest is 564, I think. So I'm going to put 564, 210 here. And I'm going to put it in different cells so you can see them, see the difference here. The lowest of my, say again?
You got a 572 there, or 581.
Oh, thank you. Gosh. Okay. Let's look at
Line 5.
Yeah. All right. So let's see. 500. Gosh, I missed that. 581. 145. Good. And the lowest activity for overhead. What's the lowest activity for overhead? 510? No. Yeah, is it 510, guys? Just check my numbers. I think my lowest number is 510, 470, right? I think.
On 503, 775.
There it is. Thank you. 503, 775. All right. That's my numerator. And now I'm going to put over here, just so you follow me. This is overhead. Now, the next activity is going to be we're talking machine hours, based on machine hours. So my machine hours, which is here, my highest number is 80/20. Do you guys agree with that? Oops.
Yes.
Okay, 80/20. And then my lowest is 64. I think it's 64.90. Correct me if I'm wrong. 64.90.
Yes.
Yep.
All right, so now, and I'm going to put here in this column here, it's going to be hours. And only I'm labeling it so that the numbers make sense. We got to find the difference between the two, right? So let's take our high number, subtract our low number, our high number, subtract our low number. Now we've got a variable. So now we've got 773.70 divided by the 1530. So I'm going to use my Excel, divide these two together. And this is what I get. I'm going to put this in green so I can use it. All right. Now, if I get $50.56.83, so my total cost minus my variable cost. Now, what the question is asking us is, let's get it. We want to know, use the high-low method to estimate the fixed and variable cost portions of the overhead based on machine hours, because overhead cost is mixed. Based on what I'm understanding, the overhead costs are mixed costs, and we need to separate the two. We need to pull out what's fixed and what part is variable of these numbers here, right? So what's going to be our issue? Now, what is our cost for machine hour? I'm going to stop sharing again. I know this gets to be a broken record. I'm going to stop sharing here, and I'm going to go back to my spreadsheet, well, my class assignment. If I can get this to, hold on a second. Stop my share, and then I'm going to share again, but I'm going to share the actual Excel, the workbook in the homework manager. Okay. So the answer to number one is, what is our variable cost per unit? And we got $50, $56 and some change. Let me switch back here. $50.56. So hopefully that. Hold on a second. I'm going back to my spreadsheet. $50.56.863. 56. I'm going to say $50.57. $50.57. That's my variable cost. I'm going to check it and see if I got it right. Should work. Oh, 2 decimal places. I wonder why my number comes off. What is my fixed cost? Now, the fixed cost is, now let's see what we have in here. Let's see. So if we take the, I don't know why that number is off. Am I rounding too much? Let's see. Because we did it right. That's absolutely right. Use our high-low. Wonder why I didn't.
I think your rounding is off.
I think so too, but I can't seem to get it right. I'm gonna do it again. Return to question.
Go back to, can you go back to your spreadsheet?
Yeah. And let me see it. I'm looking at $50.56. Look at that. I'm going to share my screen. I'm going to share the Excel spreadsheet, that is. There we go. Yeah, because I'm taking the 581. The number's a little high too.
Click on this here on the where you have the green,
Mm-hmm.
and then click up on accounting.
$50.57.
Yep, that's what it is.
Let's see. Okay, okay, all right. Oh, I'm gonna put the number in because I know we're doing it right. $50 is $50.57. I know we're doing it right. I just don't know why my rounding is off. That's one of the things I don't like it. $50.57 is what I got here. And let's see if it likes it. I don't think it does. I think it's gonna kick it out. Okay, let's do this. Let's go back. I'm gonna share my Excel spreadsheet and I'm gonna do it a different way and see what kind of answer I get. Now, the highest activity for, oh, I got you. I think I know what I did. Hold on. Now, and looking at our overhead costs, we want to go with our highest activity, and that's going to be the 581. And I'm going to corresponding the highest activity in terms of the units that's on here. So if I'm using 581 here, the highest, I'm going to use the 7955 here. Let's see if that, I think that might be my issue. My lowest number here, 503, with 64. I still get a high number, 5281. Let's see if that works. Hold on. I mean, my rounding is obviously not, it's not happy with my rounding. 5281. Yeah. Now, to determine my fixed cost, I don't know why my rounding is not working, but you got the gist. Now, how do we determine our fixed cost? How do we fix that? Well, we need to take our $52.81 and we need to multiply it by the number of units, the lowest number, the number of units we're going to multiply by. So let me stop my share, and I'm going to take the 60 share. All right, I'm going to take my 5281. I'm just going to assume, I'm not really sure why it's having problem with my rounding, but I'm going to take my $52.81 and I want to multiply it by the number of units in machine hours, and that's going to be the 8020. Not 8020, excuse me. It's going to be the 7955. Let's go through the process at the very least. Now, let me put this in dollars and units. Now, highlight this. Let's just go through the process. When we're using the high-low method, we're going to be corresponding our highest units. In this case, our overhead cost is at 581, which is this one here. Our highest in our highest overhead cost with our corresponding units, and then our lowest, which is 503 to 6490. Taking the difference between these two numbers and these two numbers, you see them here, and we divide through. That gives us our variable cost per unit. To find out what your fixed cost per unit is, all we're doing is taking and multiplying the $52.81 and multiply it by our highest units. In this case would be the D20. So the variable cost per unit is going to be 52.81, and that's going to be our variable cost. And this is going to be our fixed cost. So essentially, what this high-low method should do when you're calculating it, it should be giving you the ability to take our overhead costs. So if I take a 503,775, or I'm going to use the 581. I take the 581,145, which is this number here, and I subtract my cost of 420. This gives us our contribution margin. Contribution margin. This is our fixed cost per unit. This is our variable cost. And I wouldn't say contribution margin, I'm going to say profit because we're dealing with below the line. And that's really what the high-low method should be doing. When you're using the high-low method, what you're trying to do is take a cost that has a component of both fixed and variable and separate the two using two specific lines, the highest on one side and the lowest, and subtracting the two, dividing it through. So what in this case we have done is we were able to identify of this 581,145, the portion of it that relates to the fixed costs. That's essentially what it does. We're taking a set of numbers that combines both fixed and variable and separating out the variable portion of it and the fixed portion of it. And to do that, we have to convert the variable cost into a dollar amount or in a per unit amount and multiply by the number of units. So here, in this case here, we've got our total cost of 580, I'm going to say here, total cost. Our total cost of 581,145, we subtract out of that our fixed cost to arrive, let's see, let's put it right here. Here we go. All right. So our total cost, or in this case, our total overhead cost. So total overhead cost includes both fixed and variable. We are going to subtract our fixed costs, and what's left is our variable cost in dollars. And that's essentially what the high-low method does. We want to take our highest number, our highest quantity in units. So if we got our highest quantity in units on our overhead costs, the corresponding units with that are our lowest, and the corresponding units here. So our corresponding units, which is on the low end, is the 503 with the 6490, and our highest is going to be the 581 with our 79. So we take our 581, subtract the 503, our 7955, subtracting our 6490, and we divide these two numbers together to come with our variable cost per unit. To determine what your variable cost per dollars is, we're going to say of this number, of this total cost of 581, 403 is going to be fixed. How do we know that? Well, to do that, we're going to have to take our 403, which is going to be the $52.81, multiplied by the rate, our cost per rate, to come up with our variable cost. That's all this particular method is supposed to do. It's not to do any more than that. We just want to be able to determine, if we can, how much of this total cost here, overhead cost, includes fixed and variable. Because we know, once we know what our variable costs are, we then are able to control that. We control it by the number of units we produce. We control it by decreasing our cost, meaning labor hour could very well be decreased. Overhead, overhead time, our overhead hours, meaning, or our rent, or other costs that kind of varies as to how we use it. Machine hours we could very well manipulate in order to control those variable costs, to keep it under or above based on our units. But important note, what the high-low method does is it gives us the ability, with looking at 2 points in the entire process, what amount of our overhead costs or our total cost includes the fixed portion and the variable portion. That's all it does. It doesn't help us make a decision. It just separates the two out. That's all it does. So next, I don't know why it doesn't work very well in my spreadsheet, my class homework assignment, but I'm not going to lose too much sleep over it, because I want to make certain that you understand at least what the process is trying to do and why. Let's go to the next one. What the process is designed to tell you. It's only designed to tell you what portion of your cost includes fixed and variable. It doesn't help you determine whether or not you have a break even or your margin of safety. It just gives you the ability to separate the costs out. That's really all it does, the high-low method. I think I might have one more problem to work on. Let me see. I don't want to spend too much time. I want to go beyond our 45 minutes. So let me see if I can stop here. I think I will, because this one here might take a little while. As you're reading the chapter, we're getting close to 12:30, and I don't want to go too far here because we can definitely do the regressions later. When we're talking about CVP analysis, we're trying to predict costs, and we predict costs, and in predicting costs, we can control how much we spend, why we're spending on what we're spending, what our margin of safety is, our break-even point, and we can calculate with a level of certainty the difference or the two components that make up total cost. The two components that make up total cost is our variable portion and our fixed portion. So if you're given one blanket number, like in this case overhead, you don't know on the face of it what portion of that number is variable and what portion of that number is fixed. Using the high-low method is one way to separate them out. And that's where we're going to stop with this lecture, and then we're going to go a little bit further with using regression and using scatter plot. But for right now, the high-low method is something I think is the next step. We already know how to do our break-even in units and dollars. We already know what our contribution margin is. And we already know now how to use the high-low method in terms of what is the component of variable and fixed costs. On our class next Wednesday, we're going to review another high-low example, get it, hone that experience a little bit, and then we're going to work on regression. And regression, I'm going to try to do a regression analysis using Excel as I demonstrated. So wish me luck on that, but I think that's the next step. And I'm not asking you to learn how to do a regression. I just want you to look at one and use and find the information you need to answer a question. So don't worry about, I got to go into Excel and I got to do a regression. Don't worry, I'll take care of that. I'll do it as a demonstration. But what you should know, and what I'm going to ask you in a question is, where is the x-intercept? What does that x-intercept relate to? And how do you use that to plug it into the formula, the variable cost equation of formula? So those are the kind of questions I'm going to ask you, and the demonstration should help you, guide you on how to answer those kind of questions. Okay. Do you have any questions so far? I think what I've done today is I've gone through the beginning of the chapter 3 through pages, let's see, I'm just trying to give you an idea of where I stopped. I believe I went from the beginning of chapter 3 to page 201. That's where I stopped today. So if you could on your own read from the beginning of the chapter 3 all the way to 201, then we can pick up the remaining part of chapters 3, which is 201 all the way through to the end, with some more examples. Is that a good idea? Let me take this off. Stop screen share. So your homework for today is to read the chapters all the way through to pages 201. Don't go any further than that, because I'm going to just read what we went over today. That's all I want you to do. And then be prepared to go through the final part of the chapter, and we'll do regression, and we'll do some more examples of how to calculate the margin of safety, break even, and the profit potential. Any questions? The discussion, if you could work on your discussion by Thursday, that would be great. Let's see. So for this week, you have a discussion topic. You have chapter 3 to read. You have a homework assignment to do. I would suggest putting the homework assignment off until we get to Wednesday's class, because I might have a couple more calculations that will help you, that will get you through your homework. Any questions at all? All right. I'm going to provide a copy of this video to all of you, and I'm going to provide you with the answer key that for the problems that we did work on, and just use it as a guide to help you, just to kind of help you with understand how we're formulating these questions and how we're answering and that sort of thing. All right. All right, I'm going to take the quiet as being you are fine and you are ready to go. If you have any questions, don't hesitate to post them in the Q&A area, because everybody benefits from your questions, and I will answer them. And if a student has the answer to the question, answer it. But it's here to for anybody who have questions, and I'll answer you as quickly as I possibly can. Hopefully, I'll be able to see you guys on Wednesday. We will finish chapters number